Welcome everybody to Volatility Trading Strategies. So today I'm going to go over one of the most important concepts within the volatility ETP space, something that is central to everything we do when trying to trade products like VXX, UVXY, SVXY, the volatility products as we call them. Now the title of this video, Why VIX Futures Roll Yield is So Meaningful, there's a specific reason that I called it that, and it has to do with a recent Twitter conversation I had with someone I follow. And I might add, someone I have a lot of respect for. I follow him for a reason. He puts out good work, he's funny, I laugh when I see some of his tweets. He's a good guy, and he's got a lot of followers on Twitter. Having said that, I do always default to education, and I am trying to help as many people as possible navigate these difficult volatility markets. It makes me sick when I think about the fact that 85% of fund managers underperform their benchmarks. Regular people just aren't being taken care of. So I will always default to helping as many people as I can. That's why 90% of my work is free, hundreds of articles and videos, and I'll add 100 more every year. I've been doing this a long time. Now that final 10% sliver of my business, the thing that people pay for, is to see my actual trading strategies and the daily trade signals for my own portfolio. If people want to pay me for that, then great. There's a free trial on my website. You can check out my strategies risk-free. But if you just want to learn about the volatility space, I'm perfectly happy helping you out for free. So when I see something posted on Twitter that let's just say is curious, well, I'm a volatility trader and an educator, and this is a very important concept for people to understand, so I'm going to try to tackle it. So the tweet in question. Now, I'm not even going to show it directly because I don't want this video in any way, shape, or form to be about an individual, especially one who puts out good work. This is simply the backdrop to a very important discussion. Monthly public service announcement. With 24 days to expiration, the November VX to spot VIX spread does not mean anything. Curious, right? I've not heard anybody in the volatility space ever say that before. So as they say in the movies, this might be a teachable moment. So I'll go over this in two parts. First, I'll explain why the VX to VIX spread is arguably the very most important thing, something that everybody should always pay attention to. And then after that, I'm going to show with a real trading example why that VIX futures to VIX spread is so important. So subscribe to the channel, give the video a thumbs up if you'd like, and let's get into it. So first of all, the theory. Why is that roll yield arguably the most meaningful thing? Well, it has to do with the fact that probably roughly 90% of traders who talk about things like contango and VIX futures and roll yield, they're actually just using it to trade the volatility ETFs like VXX. That Twitter conversation went on a while, and it very quickly did become about the VXX because that's how most of us use it. And he was adamant in saying that the roll yield has no predictive ability at all on forward VXX prices. But here's the thing, volatility ETPs are not like regular stocks, and they don't derive their price based on the normal supply and demand dynamics like other stocks do. With Apple, for example, if more people buy it than sell it, then it's up, right? And if selling dominates the market, then it goes down. But with the VXX, no amount of buying or selling of the VXX itself influences its price. Volatility ETPs like VXX are very unique in that they derive their price based on a known methodology of holding a composition of first and second month VIX futures. And then there's a relationship of those futures to the VIX index spot price. This picture is showing the VIX Futures Curve. And this right here is the front month November contract that was referred to in the tweet. Here's the back month December contract. And here's the VIX index spot price. 3 points, those are all that matter. The way the VXX works is, it holds a composition of those two futures, and then based on how those held futures move in relation to the spot VIX, that's how it derives its value. At the end of the monthly expiration cycle, for just that one day only, the front month VIX future, this one, and the VIX spot value here, they have to be one and the same. We call this convergence. They converge to the same point, and for one day they are the same value. Now, whether VIX futures converge down to the VIX index, or the VIX index converges up to the futures, neither here nor there. Markets are free to move around. And I think it's best to assume there is no direct causal relationship implied anywhere in this. One of them does not cause or influence the movements of any other. All we know is, the VXX holds a combination of the front 2-month futures, and at the end of the monthly cycle, the front month future will equal the spot VIX. So the fact is, this VIX futures to spot VIX spread, which again we call the roll yield, is not only meaningful, but it's literally how the product derives its price. One could easily argue that there is nothing more meaningful than the VIX Futures to VIX Index spread. But it doesn't stop there, because the VXX doesn't just hold an equal weighting of the November and December futures. Instead, it holds what is called a constant maturity 1-month VIX future. I call this VX30, VX for the VIX Futures, and the 30 representing the 1 month. I have a whole video explaining the VIX Futures monthly expiration cycles. I'm going to link it here, and please check it out because it's a vital piece of the puzzle for anybody trying to figure out how volatility products move around. But okay, a 1-month constant maturity future, the VX30. Now, this is again something that most people misunderstand, but VXX is not a stock. It is essentially a formula that tracks an underlying index. Here it is. You can check it out anytime you want. This is the index that the VXX tracks. I'll just read the relevant part here. The S&P 500 VIX Short-Term Futures Index utilizes prices of the next 2 near-month VIX Futures contracts to replicate a position that rolls the nearest month VIX Futures to the next month on a daily basis in equal fractional amounts. This results in a constant 1-month rolling long position in first and second month VIX Futures contracts. So at the beginning of the VIX Futures monthly cycle, it's holding the front month VIX Future almost entirely. Then as time goes by, it rolls forward some of those contracts and is holding more of the back month and less of the front month. Then the monthly cycle expires with VX1 and the VIX index converging to the same point, and rinse repeat back to holding the front month almost entirely for the start of the next cycle. That's why my response to the tweet was this. With the new cycle beginning, that front future is pretty much all that is in VX30, 96% weighted now. Couldn't one argue with this much time it's all that does matter? My point was, the day after VIX Futures expiration, 96% of the underlying index that VXX tracks was holding that November future. This is another source you can check anytime you want, and I'll leave links to all of these in the description below, by the way. But at any time, you can see exactly what the VXX is holding. Now, I'm sorry I took this picture the day after our conversation, so it says 92%. But the day before, it was 96% weighted to that front month November VX future, and only 4% to the back month December future. So I would say, based on the actual functioning of the VXX, and literally how its price is derived, the VIX futures to the VIX index spread, the roll yield, is always important. It's always something to pay attention to. And its importance can't be overstated. It's how the product actually works. But to go even a step further, at no time during the month is that front month future more meaningful, because at that time, it has almost exclusive weighting in the index that the VXX tracks. So actually, we couldn't pick a time during the month that it matters more than right after that expiration. But that's just theory, right? I can say this because I do have an economics degree, so I can make fun of myself a little bit, but we could pile economics textbooks a mile high that show charts and graphs and dot plots showing all kinds of correlations and causations in the economy, right? But who cares, right? Because in the real world, most of those relationships break down. And maybe this is a case of the same thing. So now I'm going to go to the second part of this video and show an actual trading example of why that roll yield is so meaningful and how it might actually be predictive of forward VXX prices. This is a graph of the roll yield, the VIX futures to VIX index spread. To make this simple, I'm just going to take the median value. That's the absolute middle number in this sequence going back to January 30th, 2009, the launch date of VXX. So 50% of roll yield values are above that and 50% are below that. So if we want to test whether something has predictive ability or not, and is actually a useful metric for trading the VXX, we can do a very simple test. Of course, we can complicate the heck out of this if we want to, but this is as easy as it gets. If one person shorts the VXX when roll yield is above the long-term median, and another person shorts VXX when it's below the long-term median, if there's no predictability and roll yield is meaningless, then we shouldn't expect any real difference in the outcome here. If it is irrelevant, it shouldn't matter how high or low it is. We'd look at a chart, and it'd be very difficult to tell which one is which. Of course, one might be slightly better than the other just due to statistical chance, but if there's no predictive ability, they should both appear like a random walk. So here's that test. And I don't know about you, but I don't view this as irrelevant. My eyes see a pretty clear deviation between the performance of shorting VXX based on the level of VIX futures to VIX index roll yield. Statistically, I would say this qualifies as a landslide victory for one of the traders, and a painful 10-year lesson for the other one who thought it didn't matter. One of them would have made about 10 times more money with far smoother performance along the way. Now, I do have to say, don't follow this as a strategy or anything. This is far too simplistic and doesn't even scratch the surface of everything someone needs to know to navigate these difficult volatility markets. They're very complicated and they do have multiple levels of derivatives, so this is just a very basic test. Now, some people might say, oh, well, that's just a back test. All that shows is that in the past 10 years, it's been very predictive of VXX. But going forward, the roll yield has no predictive ability on VXX at all. To them, I would say, okay, I'll take the over. I'll short VXX when the roll yield is above the long-term median, and you take the under. You short VXX when the roll yield is below the long-term median. Should be the same, right? No predictive ability either way. That's when they'll probably come back and say, you know what, I don't really want to take that bet. What that test clearly shows is, in the real world where it matters, roll yield is definitely predictive. If that's not predictive, then I would say nothing is, and we might as well just be flipping coins or throwing bones to choose our next trade. Now, granted, anything can happen tomorrow, and there's no causal relationship between these things. But realistically, tomorrow will more than likely look like today. And I think that's a very good base assumption for anybody who wants to be a successful trader. We acknowledge that while anything can happen tomorrow, and we do have to be ready and protected, realistically, within a reasonable standard deviation, it'll more likely be like today. So in conclusion, of course that roll yield is important. At all times it's important. It's literally how the product works. And to ignore it just wouldn't make any sense. That would be like a NASA engineer saying, okay, we're going to try to get this rocket ship out of the atmosphere and into orbit, but we're not going to worry about calculations having to do with mass and gravity and energy. Fair enough, but please don't put a human in that rocket. Go ahead and send a robot onto that one-way trip to disaster. The same with VXX traders. If you want to say that the roll yield is meaningless and not predictive of forward prices, then in the nicest possible way, I would say, please don't put any real money on that assumption. So fun topic today. Hopefully the backdrop of a tweet doesn't mean this is some kind of beef. It certainly isn't. I meant nothing personal, nothing but respect. I just want people to have all the information so they can make more money. So check out my website. I have a volatility dashboard up there with many useful metrics just like this one, full long-form articles explaining them all, and many videos to come. Like I said, 90% of my work is free. Enjoy it. Reach out and ask any questions if you have them. And if you do want to access that final 10%, which is my actual portfolio and all the daily trading signals, then you know where to find me. Thanks for watching. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.